Welcome to the South Florida M&A Advisors Podcast, your trusted M&A team. Here's your host, Russell Cohen.
Hello, everyone. Welcome back to the South Florida M&A Advisors Podcast. I'm your co-host, Jeremy Wolf, joined by your host, Russell Cohen. Russell, how are you doing today, brother?
Doing great. How you doing, Jeremy?
I can't complain. Happy Monday to you. Got a great week in store here. And I know we did a couple of segments before. We were kind of dissecting and unpacking the recent $100 million deal that you did for a roofing company up in Palm Beach, I believe it was. And we were going through and kind of, again, like I said, dissecting the different components of a transaction like that. So I thought today you could talk a little bit and give an overview of the funding structure that's typically involved with a large scale M&A deal and how that relates to other deals or other side deals.
Yeah, my pleasure. So, more than likely, most of these companies that are trying to acquire your firm, for example, are private equity groups. And most of the time, you're an add-on acquisition. So the private equity group buys their main platform that might have anywhere from a $5 to $10 million EBITDA plus, and they buy the main platform, and then they start doing add-ons to augment the valuation of that platform. So the add-ons come fast and furious. But once again, these are professional buyers, and they know how to structure deals. They understand. They've been doing it their entire life, basically, from just coming like right out of college. They get involved in private equity. So you're at a humongous disadvantage, and that's why you need a professional M&A advisor to guide you through many different areas of the M&A transaction. But with funding, so if it's a private equity group and they have committed funding, that means they have money committed, earmarked in the bank, ready to go. Okay. And they could fund it. But what happens is they don't fund 100% of the down payment. So for example, if the business is going for $10 million per se, and they're paying the owner $9 million up front, let's give an example to make it simple, they're not taking $9 million out of their bank account. What they're doing is they're probably taking about 30% of that $9 million down payment, 2.7, and then they're going out and getting what they call senior debt. Okay. And they will get, debt. They'll get debt lenders. Okay. So if they are funded, that's how they're going to do it. They're going to put a fractional part of the down payment from their own money, and then they're going to find additional financing. If they're not funded, they have to then go out and get equity investors. Okay. Which is that 30% I was talking about, okay, and also debt lenders. So when you're dealing in private equity, either they're funded or not funded, and that will dictate how tough it will be to get the money. It's always better to have committed capital. If they have committed capital, then they have the equity to put down, and they have to get the debt lenders. If they don't have committed capital, they're getting funding for the entire amount. And that's where you could hit major challenges in the transaction. For example, in our roofing transaction, $100 million deal, this particular private equity group, this was their first acquisition. They did not have the equity and they did not have the debt. So they were raising $70, $80 million for their equity, because they were going to do additional acquisitions. So they had to raise a whole bunch of the initial money. They had to get their equity investors and they had to get their debt lenders. So we were faced with multiple challenges on that particular transaction. So what you need to take away from this is when we're working with business owners and we are dancing with private equity, I love that saying, you need to know if the private equity group has committed capital. If they have committed capital, then they're just getting their debt lending, the senior debt. Okay. That's it. And if they don't have committed capital, you got a journey. You got a journey on your hands, and with higher interest rates creates more challenges ahead in the M&A transaction. It's a very confusing process, especially for a first-time business owner trying to sell their business, because they just think the private equity is just going to write a check, and it doesn't happen that way.
Yeah, definitely confusing. And obviously the larger the scale of the deal, the more confusing it can be. So go back a little bit, right? How did the size and complexity of the deal impact the funding options available, starting from, let's say, a business that, might be a few $1 million, right? And it's maybe a more traditional type of structure where you're not having to necessarily go to private equity and explore different options. Where does one go from there? Obviously, because I think of it in terms of, I think most people think of it in terms of, you go to a bank, you get a loan.
Sure.
Right. What's the next step beyond that? When you can't secure traditional financing options, what does that look like beyond?
So SBA goes up to $5 million, and then the SBA lenders can do a second loan, probably for another 2 to potentially $5 million. So there's SBA and additional financing out there with the big banks, but it has to be the right business, and it has to have a great EBITDA, basically. But once you start dealing with private equity groups, they're not using SBA, basically. It goes, the deal structure can happen a lot of different ways. If you have a $10 million deal, a lot of times the private equity group would want you to take rollover equity. What basically means is that you are leaving 10% behind, and now you're partners with the private equity for 10%. Sometimes they do an earnout to reach the higher price. Sometimes an earnout could be 10% of the purchase price based on achieving certain levels of EBITDA. Sometimes it's based on sales. So that's how they bridge the gap to get to that 100%, by doing a rollover equity. Sometimes that's 10, 20%, and sometimes the earnouts can be anywhere from 10 to 20% also. So from a standpoint, when you're taking rollover equity, okay, you're getting equity in the new company that's buying you. The problem is you have equity, and you will not see that rollover equity until that private equity group really sells the platform. When they sell the whole platform and all the add-on acquisitions together at a higher multiple, and they typically will sell anywhere from 7 to 10 years at tops. They will sell that entire platform at greater multiple, and you'll get they call it the second bite of the apple, where potentially that 10% rollover equity could be bigger than what you got on the first time around, providing that the private equity group had a successful, all the platforms and add-ons did well, and they had a great EBITDA. They can sell it for greater multiples, and that's why people invest in private equity, because they get these great returns upon they get returns while they're invested in it, but they also get great returns when it's sold. So it's a tricky endeavor. Obviously, an M&A advisor, an attorney, you got to build a team around yourself of trusted advisors to guide you through it. But it's very common deal structure that we see.
Yeah, no, that's why you're out there, man, doing what you do. It's this complex stuff. I'm curious, what are some challenges or obstacles that you've faced? I mean, I guess you could talk about this $100 million deal or other deals that you've had in the past, and how did you get past those obstacles when we're talking about the financing and the debt structure?
Yeah, on the large roofing transaction, we had a double challenge where you had a brand new company raising their equity for the first time and getting debt for the first time, because they were raising funds for additional acquisitions. So it was a full array of problems trying to do that. But the seller has to have current books and records. The books and records can't be 6 months old. They need like current P&Ls, like year to date. So if you're behind on your books and records, then excuse me on my phone. If you're behind on your books and records, that will make it very challenging. So in this particular situation, they were trying to raise funds, $100 million, let's say. with an old P&L from the first quarter, and we were sitting June, July, and August, and they didn't have a current year-to-date P&L. So one of the issues going out to these equity investors and debt lenders, that they had old, in their eyes, old numbers. And one of the challenge was that the controller was moving very slowly, because he was trying to do the work of the company, plus carry on a quality of earnings at the same time, plus keep the numbers current. And then he hit a health problem, which he then had to resign, which then created a huge problem. And we then pivoted and got a fractional CFO, which by the end of August, beginning of September, we had current numbers. And then the private equity group was able to go out to the market and get the funding within 45 days and allowed us to close on the transaction. So if we had current numbers and we didn't run into the CFO quitting, and if he didn't have health problems, then we would have had less issues with funding. It was like we didn't have the numbers. It was a challenge raising that much money because of the rising interest rates environment. So it became a whole bottleneck. So that was a very big challenge, but we were able to get through it.
So what due diligence is typically conducted by the lenders or investors when providing funding for an M&A deal? What goes into that? How do they kind of underwrite that aspect of it?
Well, I mean, there's something called a data room, and the entire file, like 5 to 6 different layers of diligence, from financial due diligence, legal, human resources, insurance, benefits, they have access to everything. They also probably have access to the quality of earnings. And they also do a background check on the seller. So, as an M&A advisor, now, I know now to ask a seller, they're going to do a background check. So if you have issues, they're going into partnership with you.
Yeah,
so
best to bring it to the table before they bring everything to the table before,
right?
And get
everything up front so we know what we're looking at.
Yeah.
Because listen, we're everyone was young once, and people do things that they 30 years later you're like, what were we doing? But so people have issues in their past, and it gets brought back up, and sellers will not feel good about it, no doubt. So yeah, it's like a colonoscopy second time, really. So
yeah, no, I can see how this process can be extremely complicated and requires you to have, like you said, a team of extremely qualified professionals, from what you do as the advisor to a team of accountants, attorneys, and to have this in place. You have a lot of smart people dissecting these deals to make sure that it's beneficial for all parties involved. There's a lot of money.
You're having a lot of experts in their field look at your company, and it's an uncomfortable feeling. But it's
necessary. That's the word I was.
It's necessary because there's a lot of money changing hands, and you're repping that this company makes money, and there's a lot of risk involved in what's going on. So yeah, everything must check out. Everything must be checked and I's dotted and T's crossed, basically.
Yeah, makes perfect sense. Anything else you wanted to share on this topic before we wrap this one up?
Just talking to those business owners. Don't go it out alone. Once again, these buyers are professional buyers. They do it on a daily basis, and you're an expert in your field. Get your trusted advisor team together and work together with the advisors. Trust me, life will go a lot better, no doubt.
Yeah, I mean, I certainly could say if I got to a point where I needed to sell a business I had grown from scratch, I would definitely not want to go at it alone. I mean, I would seek outside help 100%.
Because every time you call a buyer or their team, you're just showing motivation from your side. So it's always better to hide behind the advisor and get the right advice, no doubt.
All right, sounds good. Russell, always a pleasure. And to our listeners, thanks for tuning in. We will catch you all next time. Everyone, take care.
Thanks for listening to the South Florida M&A Advisors Podcast. For more information, visit southfloridama.com or contact 954-646-7651.